This video provides an overview of the major concepts covered in Chapter 4, Functions of the Fed. As the central bank of the United States, the Federal Reserve, or the Fed, is responsible for conducting national monetary policy in an attempt to achieve full employment and price stability through low or zero inflation in the U.S. Because the Fed's monetary policy has a major influence on interest rates, it then has a major influence on financial markets and institutions. Chapter 4 is comprised of 4 key learning objectives. First, to describe the organizational structure of the Fed. Second, to describe how the Fed controls the federal funds rate. Third, to explain how the Fed revises its lending rule in response to the credit crisis of 2008 and the COVID-19 pandemic. And 4, to explain how monetary policy is used in other countries. The Fed, as it exists today, has 5 major components: the Federal Reserve District Banks, member banks, the Board of Governors, Federal Open Market Committee or FOMC, and advisory committees. Fed district banks facilitate operations within the banking system by clearing checks, replacing old currency, and providing loans to depository institutions that are in need of funds. Commercial banks can elect to become member banks if they meet certain requirements. All national banks chartered by the comptroller of the currency are required to be members of the Fed, but other banks chartered by their respective states are not. The Board of Governors participates in setting margin requirements, which indicates the minimum percentage of an investment in securities that must be with investors' cash. The Board also has the power to revise reserve requirements imposed on depository institutions. The main goals of the FOMC are to achieve stable economic growth and price stability, or low inflation, which would stabilize financial markets and interest rates. The FOMC attempts to achieve its goals by controlling the money supply. A number of advisory committees exist to make recommendations about economic and banking issues, offer views on issues specifically related to banking institutions, and offer diverse views on economic circumstances and the financial service needs of consumers and communities, with particular emphasis on low and moderate income populations. This exhibit shows the relationship among the various components of the Federal Reserve System. The advisory committees advise the Board, while the Board oversees the operations of the district banks. The Board and representatives of the district banks make up the FOMC. Finally, the Consumer Financial Protection Bureau is responsible for regulating financial products and services, including online banking, certificates of deposit, and mortgages, by acting quickly to protect consumers from deceptive practices. Now let's move on to the Fed control of the money supply. The Fed implements monetary policy with the goals of achieving full employment, low or zero inflation, and moderate long-term interest rates. Through its monetary policy, the Fed can influence the U.S. economy in a number of ways. First, because the Fed's monetary policy affects interest rates, it therefore has a strong influence on the cost of borrowing by households, and thus affects the amount of monthly payments on mortgages, car loans, and other loans. Second, monetary policy affects the cost of borrowing by businesses, therefore influencing how much more money businesses are willing to borrow to support or expand their operations. Through its effect on the amount of spending by households and businesses, monetary policy influences the aggregate demand for products and services in the U.S., which in turn influences the national income level and employment level. Because aggregate demand can affect the price level of products and services, the Fed indirectly influences the price level and hence the inflation rate in the U.S. Third, because the Fed's monetary policy affects interest rates and therefore the return that is required by investors on investments, it can influence the prices of debt and equity securities. The FOMC meets 8 times a year. Prior to each meeting, the members receive pre-meeting economic reports of the regional economic conditions. At each meeting, after attending a series of economic presentations, the committee determines targets for the money supply growth level and the interest rate level. Once the decisions have been made, a public statement is issued, followed by a release of the official minutes of the FOMC meeting, and actions are taken to implement the monetary policy dictated by the FOMC. If the FOMC determines that a change in monetary policy is appropriate, the 2 administered rates that the Fed currently uses to implement its monetary policy under the ample reserves framework are the interest rate on reserve balances, or IORB, set by the Board of Governors, and the rate on the overnight reserve repo facility, ONRRP, set by the FOMC. The IORB rate is the interest rate that the Fed provides to banks on their reserve accounts. The ONRRP rate is the interest rate that the Fed provides to other financial institutions and government-sponsored enterprises such as the Federal Home Loan Banks or money market mutual funds. Under the ample reserves framework of monetary policy implementation, the Fed can influence the federal fund rates by changing the two administered rates, IORB and ONRRP. Under the scarce reserves framework of monetary policy intervention, the Fed can influence the federal funds rate through the purchase or sale of Treasury securities in the secondary market. When the Fed implements its monetary policy, it must also consider the measure of money on which it will focus. The most narrow form of money, known as M1, includes currency held by the public and checking deposits at depository institutions. The M1 measure does not include all the funds that can be used for transaction purposes. Therefore, a broader measure of money called M2 exists, which includes everything in M1, as well as savings accounts, small-time deposits, and money market deposit accounts. Another measure of money called M3 includes everything in M2, plus large time deposits and other items. Even though the Fed focuses solely on controlling a targeted federal funds rate, it has major influence on all types of interest rates, which means it also has a major influence on economic conditions. When the Fed changes the target federal funds rate by changing the two administered rates, those changes impact other short-term rates, which in turn affect long-term rates. Along with controlling the federal funds rate as the main monetary policy tool, the Fed could consider changing the primary credit available through its lending facility as a means of controlling the money supply or adjusting its reserve requirement ratio. In addition, the Standing Repo Facility, or SRF, exists as an additional monetary policy tool to provide liquidity to financial markets and help whenever necessary with the implementation of the ample reserves framework, especially during times when markets are under stress. Next, let's discuss the impact of the Fed's interventions in times of economic crisis. During and after the credit crisis of 2008, the Fed not only engaged in traditional open market efforts to reduce interest rates, but also implemented various non-traditional strategies in an effort to improve economic conditions. In March 2008, the Fed provided funding to Bear Stearns that enabled it to avoid filing for bankruptcy. Now, Bear Stearns was a securities firm, not a depository institution, so ordinarily it would not have been allowed to borrow funds from the Fed. However, it was a major provider of clearing operations for many types of financial transactions conducted by firms and individuals, and in the event of bankruptcy, those financial transactions might have been delayed, potentially creating liquidity problems for many individuals and firms that were to receive cash as a result of the transactions. Also in 2008, the Fed implemented a variety of innovative strategies that were intended to have favorable effects on the economy, beyond what would be achieved through the Fed's traditional monetary policy of purchasing short-term Treasury securities. These strategies are broadly referred to as quantitative easing. One of the Fed's main concerns during the credit crisis in 2008 was that the market value of mortgage-backed securities had weakened substantially due to the high default rate on mortgages. So at the time, the Fed's quantitative easing strategy was heavily focused on purchasing mortgage-backed securities. As the Fed increased its purchases of mortgage-backed securities, the prices of those securities rose. In addition, investors slowly began to reinvest in the risky debt securities market, which resulted in higher liquidity in the market for those securities. In this way, the Fed's actions helped stabilize the housing market. Also in 2008, the Fed created a Term Asset-Backed Security Loan Facility, TALF, that purchased high-quality bonds backed by consumer loans, credit card loans, or automobile loans, and in doing so, the Fed encouraged financial institutions to offer new consumer loans. During 2008 and 2009, the Fed used another form of quantitative easing when it purchased a large amount of commercial paper. Because although short-term rates were close to zero in 2010, many large expenditures by corporations and individuals are subject to long-term interest rates. The Fed attempted to reduce long-term rates to encourage more long-term borrowing by corporations for capital expenditures and by individuals to purchase homes. While the Fed took much initiative to improve economic conditions during the credit crisis, opinions vary on exactly what the Fed should have done to improve the economy. Some critics argue that the Fed's actions addressed only the financial institutions but ignored other sectors of the economy. However, the Fed's actions to restore liquidity in the markets didn't just help financial institutions, but were necessary to ensure that all types of corporations could obtain funding to support or expand operations, and that individuals could obtain funding to purchase homes or automobiles, thereby stimulating the economy and creating jobs. During the COVID-19 crisis in 2020, the Fed responded quickly and employed traditional and non-traditional monetary policy tools to improve the economic conditions, provide liquidity to the markets, and encourage borrowing and spending by households and businesses. By March 2020, the Fed reduced the target federal funds rate to zero and indicated it would keep the federal funds rate at this level as long as needed. In addition, the Fed restarted buying long-term U.S. Treasury securities and mortgage-backed securities to help financial markets function as normally as possible during unprecedented conditions created by the healthcare crisis. Finally, the Fed introduced temporary lending facilities to help households and businesses to borrow and have access to funding through the Paycheck Protection Program Liquidity Facility to help small businesses and provide them with the necessary credit to support their employees' payrolls. The Main Street Lending Program was also instituted to provide lending to small and mid-sized businesses. The last major concept in the chapter relates to global monetary policy. Each country has its own central bank that conducts monetary policy with similar goals of the Fed to reflect price stability and economic growth, commonly using open market operations to control their money supply and influence economic conditions. Because country economies are largely integrated on a global scale, the Fed must consider the economic conditions in other major countries when assessing the U.S. economy. In 2012, 12 member countries of the European Union, or EU, replaced their national currency with the euro, and 8 more countries have adopted the euro since then. The European Central Bank, or ECB, based in Frankfurt, Germany, is responsible for setting monetary policy for all European countries that use the euro as their currency. However, there are some limitations on the Eurozone monetary policy. Because all countries participating in the Eurozone are subject to the monetary policy imposed by the ECB, each participating country no longer has full control over the monetary policy implemented within its borders at any given time. Thus, any participating country cannot resolve local economic problems with its own monetary policy.